Hey, VA borrowers, my name is Steve Doherty. I'm the Raleigh VA loan guy. I'm a loan officer in Raleigh, North Carolina, and a United States Marine Corps veteran. Today, I want to talk to you about a topic I see all over social media, all over YouTube, which is building a real estate portfolio utilizing VA financing. Today, this is kind of going to be a rain on your parade edition, right? A fun police session and maybe a little bit of a reality check. A lot of this stuff that you hear about this is showing you all the advantages of a VA loan, 100% financing, no mortgage insurance, low interest rates. What they're not telling you is there are natural barriers built into VA rules to prevent you from rapidly building a real estate portfolio using your VA financing. You must be aware of these rules before you embark on your journey of wealth building by using your VA loan. Please listen to this whole video to learn about everything that you need to know before using your VA loan to build a real estate portfolio. Before we dive into the topic today, please subscribe to my channel. I post videos frequently on all things VA and all things mortgage lending. I'm here to give you the straight version of mortgage lending without any fluff. Please click below to subscribe. I'll also leave my contact information in the video description and a comment below if you would like me to get you pre-approved for a mortgage. Okay, so let's say you want to build a real estate portfolio, multiple properties, you want to have a real estate empire, and you want to do so using that hard-earned VA entitlement. Why would you want to go VA versus a conventional mortgage? Well, on a conventional mortgage, purchasing as an investment property, you're going to need to put 25% down. And interest rates are higher on conventional mortgages. And then on top of that, they're even higher on conventional investment properties. So the benefits of a VA mortgage are pretty clear. 100% financing, no mortgage insurance. Even though you're not making a down payment, it's pretty obvious why you'd want to go VA. Now, you can purchase primary residences with a conventional mortgage and do so with as little down as 3%. Even 3% doesn't stack up to 100% financing, especially when you consider the VA mortgage does not have monthly mortgage insurance. So kind of a no-brainer, right? Better rates, no down payment. Why not go VA every single time? Well, there's a little catch. The VA loan is not designed to help you build a real estate portfolio, right? It's not made, it's not created, it's not funded by taxpayers to help veterans become real estate moguls, right? It's intended so that you can purchase a primary residence with little to no barriers, right? Extremely permissive debt to income ratio, permissive on poor credit. You do not need a lot of cash because there's no down payment, right? Low monthly payment, even with a small down payment because there's no monthly mortgage insurance, right? These are designed to put people into homes that they are going to live in. That does not mean that it can't eventually be used as an investment property. But if your strategy is to, over time, build a real estate portfolio using your VA entitlement, you have to be mindful of why the VA loan exists in the first place. If you think it can be manipulated, you might get yourself into trouble, right? If you are trying to build a real estate portfolio quickly, you're going to get in trouble using a VA entitlement. So all mortgage programs that are designed for primary or principal residences, that is a house that you are actually going to live in, you're going to occupy, or your family's going to occupy, have restrictions, right? For the most part, these programs are either directly subsidized by the federal government or they're kind of loosely monitored and kind of have created a secondary market by the federal government, right? Think Fannie and Freddie. So they're offering enhanced rates and enhanced programs because there is sort of a legislative goal to get people home ownership, right? You have to be mindful of that restriction. Now, on a VA loan, it is true that those occupancy requirements are much less restrictive than on a conventional mortgage or really any other mortgage. Any other mortgage program is going to say your butt needs to be in that house within 60 days of closing, right? That must be your intent at closing. The VA loan is not that restrictive, but it's sort of permissiveness is built into it for a reason. It's not because you don't have to ever live there. It's because there are scenarios when, let's say you're deployed, and you're going to buy a house before your deployment, you're obviously not going to be able to occupy it 60 days later if you're going to be, in the Middle East for 14 months. So that permissiveness is built in because you may not be able to get there, right? You may not be able to move in, is to eventually convert a primary residence into an investment property. The permissiveness is not there because you never have to move in, right? So be careful with this. Now, there are some levels of, it's not as restrictive as other programs, but there are other principles that will apply here when you're purchasing multiple homes. Let's say you buy a 3-bedroom home in March, right? And then 1 month later, you want to buy a nearly identical home across the street. Which home are you going to be occupying? Which home is your actual primary residence? You're going to run into problems here. One or the other was likely purchased as an investment property. You would need a really, really good reason to be able to buy a near identical home so contemporaneously, right? And this is going to set off alarm bells for any investor. Now, at the beginning of the process of purchasing a home and you're looking for mortgage financing, you're going to talk to someone like me, right? A loan officer. A loan officer is really kind of your advocate, and we have an incentive to get you to close loans. So if you approach a loan officer with this idea that you are going to buy a whole bunch of homes using your VA entitlement over and over again, they may not put the brakes on you, right? They may not rain on your parade. They may not be the fun police. But eventually someone will have to review your file that has less incentive to be your advocate and more incentive to protect the bank. If you are purchasing a home that you don't really intend on being a primary residence, that bank could get stuck with your loan, and that's not what they want. They want to be able to sell your mortgage as a mortgage-backed security on the secondary market. So eventually, someone may catch on to this. Now, purchasing a home across the street that's nearly identical 30 days later, that's sort of the extreme example, right? If you're purchasing a home in the next town over and it has significantly more square footage and it's closer to your place of work, and let's say it's a year later, then that's going to look much less suspicious. I'm going to let you in on a little inside baseball as to how the mortgage industry works. The vast majority of loan officers like me are compensated on a commission basis only. Our commission is based on a percentage of the loan amount, right? It's anywhere from 0.5% to maybe 1.2% of the loan amount. So there is an incentive for loan officers to push loans or to try to come up with a reason why they can get around the rules to get you into a home. Now, that may sound like they're your best advocate. And in that scenario, they have your best interest at heart, right? They are trying to get you into a home. They're your buddy. You guys are on the same team. However, every loan, including VA loans, are reviewed by an underwriter. The underwriter's position is more of an advocate for the bank. On VA loans in particular, for an underwriter to underwrite a VA loan, they must first have to be sort of registered and approved by the VA. Their underwriting of particular files, every file, is also monitored by the VA. So whereas the underwriter is kind of the vanguard for the bank, if they make mistakes, meaning they let you buy a primary residence or buy an investment property as a primary residence using a VA loan, and that was actually false, and that mortgage was improperly underwritten, the VA will find out and the VA will flag them. So what does this dynamic do? What this means is you might get good news from someone like me at the beginning of the process. Yep, no problem. We're going to buy this using your VA entitlement, 100% financing. A few weeks later, an underwriter may step in and say, absolutely not. This is not a primary residence. They can't go VA. What does it turn into? Conventional loan. What does that turn into? An investment property, 25% down, much higher interest rates, right? And now you're looking at a completely different investment picture. Now, depending on where you are in the country, maybe that gamble is worth it for you, right? If you are purchasing a home as a primary residence or getting primary residence pricing, but you know that you're not going to occupy it, that's mortgage fraud. So maybe that is enough of a deterrent. But in states like North Carolina, where you have non-refundable deposits, we call it due diligence in North Carolina, if you get under contract and you drop $3,000 and then 3 weeks later, the underwriter says this can't be done with a VA loan and you back out of that contract, you lose your due diligence suspicious. Money. So while long story short, just because the VA has more permissive rules in terms of occupancy doesn't mean it has no rules regarding occupancy at all. You have to have the intent to occupy the home, due diligence closing. So while it may seem like a good idea to be doing business with a loan officer who is all on board with your plans to purchase multiple investment properties using your VA loan, it may come back to bite you. That is just a summary of how the mortgage industry works. No one's probably told you about that, and your loan officer who's signing off on the scheme is not going to let you in on that as well. Let's get back to sort of the substantive discussion. Okay, so we've established that it is risky to just go out and start purchasing investment properties using a VA loan, right? And there's the second problem with this strategy of rapidly building or purchasing homes using your VA loan. Yes, you can use your VA entitlement over and over and over again. However, there is a maximum amount of sort of outstanding debt that you can have to the VA. Right? That's not really. If you have outstanding mortgage debt, you're going to be capped on the next loan, right? You can only borrow so much on the next one. So if you have a primary residence that's say $500,000, you're not going to be able to buy 5 more investment properties or properties period using your VA entitlement. Eventually, you're going to have to be making massive down payments. And those down payments will exceed the down payment of a conventional investment property of 25%. So eventually this strategy is going to kind of burn out. You're not going to be able to buy 8 investment properties all with your VA loan all in succession. Okay, so admittedly, I've painted a pretty cloudy picture, right? A pretty negative picture of using your VA entitlement to purchase investment properties. It doesn't mean it can't be done. It's just much safer and much better to be done methodically. Right? If you are purchasing a primary residence, every time you PCS, there is absolutely no question in terms of your intent to occupy that as a primary residence. When you leave, when you depart that primary residence, there are no restrictions for renting that old property out, right? So if you're doing it every time you actually relocate, your intent to buy that as a primary or principal residence will never be questioned, right? Now, that does not resolve the issue of you having outstanding charged VA entitlement on that old property. Maybe it's old property number 1, number 2, and number 3, right? Eventually, you are going to have to free up that entitlement to purchase another investment property with your VA entitlement. So how can this be done? How can you restore your entitlement, right? Well, there's a couple things to keep in mind, right? You can pay the entire balance off, right? But that may or might not be feasible depending on the loan balance of that mortgage. You could sell the property and now you've also restored your entitlement because you no longer have outstanding VA debt, but then you're not really building a real estate portfolio, right? You're maybe only holding a couple properties at a time. Maybe you want to own 12, right? So what are some other alternatives? Well, you can refinance. You can refinance that VA mortgage to free up your entitlement. But if this is your strategy, and this is really, really important to keep in mind, if this is your strategy, you will now be refinancing an investment property. You don't occupy that home anymore. So when you go to refinance it as a conventional mortgage, you will be getting investment property refinance interest rates. So what does that mean? Number one, your interest rate could go up, right? If you have let's say you have a 6% interest rate in a VA loan, and you're going to refinance 18 months later and rates haven't really improved over that time period, or maybe they've gotten worse, that interest rate could be much, much higher. Here's the other problem. This is probably a bigger barrier. In order to refinance a property, as an investment property, you need a certain amount of equity in the property. Realistically, the new loan balance can't be any more than 75% of the appraised value. So if you purchase that home with 100% financing, let's say you bought it for $100,000, and 2 years later you want to refinance it into a conventional mortgage to free up your VA entitlement, the most that new mortgage could be is 75% of the value now. So let's say over the course of a year, you've owned this investment property for 1 year. It's appreciated by $10,000. So it went from $100,000 to $110,000. The max loan amount that you can have on that $110,000 property is around $82,000. So that means you would have to have paid the balance down on that 100% financing loan by $18,000 over the course of a year. Even if that's 3 years, that's a pretty remarkable equity gain. You'd have to be very, very aggressively paying down that balance. Or you'd have to be bringing cash to the closing table to pay that mortgage down to 75%, right? 75% of $110,000. You'd be bringing cash in order to free up that entitlement. Well, if you're bringing cash to that transaction to free up entitlement to make 100% financing purchase on your next investment property, it doesn't really make any sense, right? That, again, is placing another restriction on a rapid portfolio building strategy using the VA loan, right? Here's another thing. When you refinance that mortgage that had a starting balance of $110,000, on a refinance, you have closing costs, prepaids, and escrows, okay? Now, that won't be $50,000, but it could be somewhere between $5,000 and $12,000. If you're not prepared to pay cash for that, you need to add it to the loan amount. So now, now you have to have a balance of no more than 75% of $110,000. And within that, you have to finance those closing costs, prepaids, and escrows. That means you have to even more aggressively pay down that balance in order to conduct this refinance scheme to free up your VA entitlement. So what does this all mean? Again, it's going to be really hard to rapidly build a real estate portfolio when you're successively using the VA loan, right? Number one, you could get in trouble for doing so if you're not really buying it as a primary residence. Number two, you're going to run into these kind of mechanical barriers, right? You don't have enough equity in the home to refinance. Probably don't have enough cash to pay it off to free up that VA entitlement. But if you're PCSing every 3 years and purchasing a home every 3 years, then you can, and these are modestly priced homes, you're probably not going to burn through all your VA entitlement. And over the course of 3 years, you're likely to get more appreciation on those homes than you would over the course of 90 days or 6 months. So if the home is appreciating over, let's say over the course of 3 years, it goes from $110,000 to $140,000. Now you have more room, more flexibility to get that new loan to be 75% of that new property value. So in summary, if you've been told that you can build this massive real estate portfolio using a VA loan, you need to look at this critically. If you're planning to do this over a 20-year military career, or maybe you're 5 years into a 25-year military career, and you're going to slowly build this up, that is very possible, and you won't be running afoul of any rules. If you plan to buy 5, 6, 7 properties, right, over the course of 5, 6, 7 years, all using VA financing on each one of those purchase transactions, you're going to run into trouble. Number one, you may not be able to purchase the home anyway. Number two, you're not going to have enough VA entitlement to keep purchasing those unless you're taking aggressive steps to those previous properties, either paying the balances down, bringing cash to the closing table on the refinance, or selling the properties. And again, like I said before, if you're selling, you're not building, right? So be careful when you're approaching this. If you would like to lay out a specific plan on how to build a real estate portfolio, either quickly using a conventional mortgage or over time using a VA mortgage, please call me. I can lay this plan out for you. And then you can have a good idea of how long this will take, and you can take that plan to a financial advisor. Again, thank you so much for listening. My name is Steve Doherty. I'm the Raleigh VA loan guy, a loan officer in Raleigh, North Carolina, and a United States Marine Corps veteran. If you would like me to build a plan for you on how you can utilize your VA entitlement to build a real estate portfolio, or provide some honest feedback to your current strategy, please reach out to me. My contact information is in the video description and in a pinned comment below. I look forward to hearing from you.